Hello, and thank you all for joining. We've got a great webinar ahead of us today. And if you're on today's call, I would expect that you're either retired or at least nearing retirement and are looking for some creative tax strategies to help lower retirement tax. Now, I want to start today's conversation by saying that there is no one solution to eliminate tax in retirement. However, there are many strategies that one should be considering. So, what we're going to do today is talk about, in my opinion, the top 5 tax reduction strategies that are applicable to a lot of retirees at one point or another. And many times, when utilizing these strategies in conjunction with one another, you're ultimately able to lower tax for the better. And I do like to mention before getting into the meat of today's conversation that any tax strategies usually should be reviewed with a CPA or your tax advisor just to ensure that they're appropriate for your unique situation. Now, for those that don't know us, though, we're a boutique wealth management and financial planning firm here in Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of which are on the line today, is work with them on their comprehensive financial planning and investment management needs. Our firm's planning process involves building well designed financial plans, organizing our clients' investments in coordination with their plans, and then ensuring that any outside planning items have been handled. And education is at the core of everything that we do, which is one of the reasons that we host these webinars. And here's a quick overview of our team. Within the firm, we have 7 advisors, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's just get into today's topic. And shown here, as many of you know, is what we call the pyramid of financial planning. And while there are a lot of aspects to it, we're going to be specifically today talking about tax, retirement planning, and lastly, organization and being in control. And for our agenda, we're going to be reviewing 5 strategies that can help to save in tax, ultimately meaning more money available for you in your retirement years. And these strategies will essentially teach you how to hopefully save in tax with your Social Security benefit, on IRA distributions and various account distributions, in your non-retirement investment accounts, and potentially on earned income that you make while semi or fully retired. So let's dive in with the first, which is how delaying Social Security can actually result in tax savings. And before explaining this strategy, I think that it is important to understand how Social Security truly works. So to do a quick review of Social Security, you should be aware of the following. First off, only up to 85% of your benefit is going to be subject to taxation. That means that no matter what, 15% of your benefit is already tax-free on a federal level. And when it comes to the taxes that you pay, you're always going to have to pay some federal tax unless you're in a very low tax bracket, which is going to be calculated based off of your earned income for that year. But what most people don't know is that most states do not tax Social Security. So for all those Californians on the call right now, you're probably wondering, am I going to be taxed? The answer is no. The state of California does not tax Social Security. Additionally, you'll receive approximately an 8% increase in your benefit each year that you delay claiming up until age 70, though. And lastly, married couples retain the larger of the 2 benefits upon the death of one spouse. They do lose the smaller benefit, though. So what does this all mean for you then? How does delaying save you in tax? Well, think about it. If you were to wait until age 70 to claim your benefit, and only up to 85% of your benefit is going to be subject to federal taxes and potentially no state tax assessed, then from a tax perspective, it pays to postpone your benefit and usually just draw from less tax efficient vehicles first. For example, let's say you withdrew from an IRA. That would result in federal and state taxes. So in many cases, it actually pays to pull from those accounts earlier, resulting in less IRA distributions in retirement, but more Social Security withdrawals. Essentially, by delaying Social Security, you are locking in a larger benefit for the future that is more tax favored than other retirement vehicles. So in summary here, the benefits to waiting it are that you receive a higher guaranteed income on a more tax efficient vehicle. Additionally, it potentially allows you to keep your taxable income low up to age 70 because you're holding off on those Social Security distributions. And this then will allow you to execute some of the other tax related strategies, which we're going to talk about shortly. And lastly, you do get a larger yearly cost of living adjustment and potentially a larger survivor benefit by waiting. The main negative to waiting, though, is that you're going to have less cash flow prior to claiming at age 70, which can actually be beneficial, and we're going to talk about this shortly. But in simple terms, Social Security is a tax favored retirement funding source. So in many cases, it does pay to wait to age 70. Too often I see, though, is that people claim the moment they retire, and what they don't know is that you can wait, you can strategize, and you can organize your Social Security along with all of your other retirement assets. Now on to strategy number 2, which is the Roth conversion ladder. Essentially, this strategy involves prepaying taxes to ultimately save more in tax at later retirement years. So let's review the specifics now. And this strategy is truly a process. So let me explain each step one by one. First off, it only works if you have money in a pre-tax retirement account. This could be your 401k, 403b, IRA, maybe a thrift savings plan. But if you have money there, then you potentially can follow this strategy. And the first step is retiring and holding off on claiming Social Security. The strategy involves maintaining a low income tax bracket. So to ensure that you're in a low tax bracket, often it does pay to wait on pulling Social Security, like I just mentioned. Next, you'll want to make sure your money is in a traditional IRA account. To do these conversions, it's almost always easier to roll over all your various retirement accounts into one consolidated IRA before attempting to convert. But technically speaking, you could convert directly from 401k, 403b, or another account. But in this example, let's say the money's in an IRA, and once it's in the IRA, then you can begin converting the IRA funds to your Roth IRA account. Now, essentially what this is you are moving retirement funds from a pre-tax retirement account to a post-tax Roth vehicle. Pre-tax means that the money is going to be taxed upon distribution. Post-tax means that you generally do not have to pay taxes on the distributions. So when you do this conversion, you're actually paying the taxes on the amount that you're converting, and the tax you pay is going to be calculated off of your adjusted gross income for that calendar year. And that is why this strategy works when you are in a low tax bracket. Moving on to step 5, you'll continuously want to keep income low and follow this strategy essentially until age 70 when you claim Social Security, or whenever your income tax bracket increases to a level where it doesn't pay to convert. You may be asking yourself, what would I use as income in the interim during those years where I'm following this strategy? Well, to keep income tax liability low, you maybe want to utilize funds that you have from lower taxed liability vehicles. For example, cash accounts, potentially non-retirement accounts with minimal security appreciation. Additionally, you do want to wait at least 5 years before withdrawing any of the converted funds due to the 5-year rule to make it a qualified distribution. And lastly, you do get to withdraw these funds completely tax-free, so long as it's a qualified distribution, which means you wait 5 years and are at least age 59 and a half. Now, the biggest question I get from clients is, why do I want to pay tax when I could just keep my money in an IRA pre-tax vehicle growing tax-free for years to come? Well, the answer lies with your tax bracket. So let me show you. Take a look at this illustration. Now, this is just a hypothetical example of a couple who retired at 65 and 66. Take a peek at the first 5 years of their retirement on the left. Their income is essentially nothing. You can see this by looking at the circled box at the bottom of the document. This means that not only are they in the lowest tax bracket possible, but they're essentially completely wasting their standard deductions, and they're wasting the ability to lock in a low tax rate on their earned income. Now, look at their income once they reach 73. Both Social Security benefits add up to over $90,000, and they're forced to take required minimum distributions from their pre-tax retirement accounts, which would mean even more income, bumping them up to a projected income of about $125,000. Essentially, they went from an income of zero in their mid-60s to an income of $125,000 in their 70s just over the course of a few years. So in this example, if they converted IRA funds during, let's just say, the first 5 years of retirement and were able to keep their income low, they'd potentially pay very limited tax on those conversions, and then they could then use those converted funds tax-free in retirement. Additionally, they've moved money to a more, or I'm sorry, when they're moved the money into their Roth retirement accounts, they don't have to take those required minimum distributions. So ultimately, they're reducing their future RMDs as well. That's something a lot of people miss. So in summary, if you're in a lower tax bracket than you are projected to be in the future, it may make a lot of sense to do a conversion. And not to mention that the income tax rates are projected to increase by 2025. And I do want to say, I've done this strategy for clients. I've done it for a number of people, and it's fairly straightforward. Just often people don't utilize the strategy because they're a little nervous. And that's why I always say, talk to a CPA, talk to a tax advisor, talk to a financial planner, project everything out, and that way you can see if it makes sense for your unique situation. But I'll leave it at that. And if you have any questions, please save them, as we will be opening up to questions at the end. Now, strategy 3 is in regard to how you distribute from your various accounts. Obviously, if you're following the Roth ladder strategy, you'll want to distribute from cash accounts first to keep your AGI low. But what I'm about to review will give you some food for thought on what to do once you're done with this strategy, maybe in your 70s, 80s, even 90s. And there are 3 strategies that I want you to consider. One strategy is not better than another. They all have their benefits and they all have their negatives. And what I want to do here is make you all aware of the specifics so you can decide which is best for your unique planning. The first strategy is the traditional method for distributions. This strategy is what most people follow, which essentially allows for the longest tax deferral in your retirement accounts. Essentially, what you do is you pull cash and non-retirement investment accounts first to fund your day-to-day lifestyle. This allows your pre-tax IRAs and post-tax Roth IRAs to continue to grow. Once you've used up all the cash and all the non-retirement investments, then you draw from your pre-tax IRAs, which count as income when distributed. And once you fully have depleted, you pull from your Roth IRAs, which are completely tax-free. As mentioned, the benefit is that it allows for the longest tax deferral of all your retirement accounts. The negatives, though, are that you will have extremely large swings in your taxable income year to year in a lot of cases, meaning your tax bill will be all over the place. For example, when you're utilizing cash accounts, you're not really going to pay any tax on distributions, and you're not most likely going to use your standard deductions when you file your taxes. Now, when you're drawing from your IRA accounts, you're immediately going to get bumped into a higher tax bracket than when you were pulling from cash. And then when you switch back to your Roth accounts, you're most likely going to go back to a low tax bracket. So that leads me to the second strategy, which is the proportional method. And this sounds exactly like what it is. You draw from all your accounts at once in proportion to how much value is in each account in relation to your total net worth. Now, this has its benefits, which are it essentially spreads out a lot of your tax liability over the years instead of just a handful of years. And it might help to lower taxes. And it ensures that you're also going to be utilizing your standard deductions. The negatives to this strategy are that you may actually be missing out on some tax strategies. And in many cases, it's a combination of these strategies that are typically best. And that is why I like to always say, model out your planning so you have an idea of what you're going to be paying in tax rather than just winging it. And that leads me to the final strategy, which is a little more complex. And that's what I call the capital gain conscious strategy. And to understand, you need to first be aware that if you maintain income under $44,625 as an individual filer or $89,250 as a joint filer, then your federal capital gains tax rate is 0%. That's right. You don't have to pay the 15% federal capital gains tax if you are in this low tax bracket. And for those that aren't aware, the capital gains tax that you pay is what you pay for appreciated securities in your non-retirement accounts once you've sold them. It's essentially paying tax on any gains that you may have received. So what's the strategy here? Well, it's to keep income low and to sell out of highly appreciated securities during those years to avoid that large federal capital gains tax. And in some cases, that tax can also be 20% if you get into a significantly higher tax bracket. Now, the benefits to this strategy are obvious. You are going to save money if you do it correctly. The negatives, not so obvious. And they are that it is extremely hard to perfect this strategy. It is very hard to project and accurately plan for your adjusted gross income year to year because so much goes into calculating it. And you have to complete this strategy during the calendar year, not afterwards. So essentially, you're just doing your best to estimate your AGI. But if you underestimate and push yourself into that capital gains tax bracket, then you're going to go from paying 0% all the way up to paying 15%. And keep in mind that capital gains add to your AGI. So if you have $0 of earned income, let's just say, and you go and sell out of a bunch of appreciated securities and result in $100,000 of gains, well, you're not going to pay no tax. You're going to end up paying the $15,000, 15% tax on that $100,000 gain. And then lastly, one negative to this strategy is it's time consuming and could result in big mistakes, which could result in a large tax bill. So that's why I always say, talk to a CPA here. They're the ones that know this best. But it is worthwhile explaining because many people do follow this strategy in conjunction with others that we've talked about to ultimately lower tax. So on to the fourth strategy, which does go hand in hand with the last two, which is tax conscious investing and strategies on how to manage your non-retirement investment accounts to save on tax while in retirement. So I've been mentioning a lot today about how you can utilize non-retirement accounts to keep your tax liability low. But these accounts can also increase your tax liability if you're not managing them effectively. Basically, taxable accounts give you a 1099 statement at year's end, and there are three main items on this statement that can increase your tax liability. Generally speaking, dividends, bonds, and dividends, bond interest, and capital gains. Each of these are taxable in most cases, and they all add to your AGI. So by keeping them low, you can potentially save in tax. So let's review. First, let's talk about bond interest. Bond interest is considered income, and you pay income tax on it. But if you purchase municipal bonds, then the interest you receive is tax-free federally and tax-free from a state level if you purchase state-specific munis. So municipal bonds may be a great investment to place within your non-retirement investment accounts. And IRAs, they're typically not as ideal because you'll end up paying tax on that bond interest when you distribute. So other bonds may make more sense within your IRAs. Now, let's talk about mutual funds. Did you know that you're usually assessed yearly tax within a mutual fund, even if you never sold the fund at a gain? Well, why is that? Well, mutual funds that are actively managed buy and sell securities within the fund itself at all times. And because of this, at the end of the year, they typically distribute capital gains to investors, which result in tax that you have essentially have zero control over. So how do you avoid this? Well, purchasing index-based funds is one way to help to get around this capital gains issue. Index funds are generally passively managed, so there is minimal buying and selling of the fund itself, which does usually result in less capital gain distributions. It's not always nothing, but it's less in most cases than actively managed funds. So index funds are generally very good to have in a taxable account. And if you want to have actively managed mutual funds, well, once again, those might be better placed in your retirement accounts for tax reasons. Another strategy is to set dividends and interest to pay cash rather than to reinvest in your taxable accounts if you are using that specific account for income. For example, most investors have their dividends and their interest set to reinvest into the security that distributed that dividend or interest. And then when they need the money, they sell securities in the account to raise cash. Well, by setting dividends and interest to stay as cash, it actually helps to avoid having to go out and sell appreciated securities, which may result in tax savings. So in summary here, you're already paying tax when you receive a dividend or interest payment. So if you regularly need cash in that account, then it's best to just keep the dividends and interest as cash. In a retirement account, that strategy doesn't really apply. And the last strategy I want to review is tax loss harvesting. Now, tax loss harvesting is essentially selling securities that have dropped in value to capture a loss. Now, when you capture an on-paper loss, you're able to do a few things which reduce tax. First off, they offset any capital gains for that year. And as you know, capital gains result in tax. So by harvesting losses, you save on tax. Secondly, if you've offset all capital gains, you can then offset up to $3,000 of earned income, which lowers your tax liability. And lastly, if you did the first two and still have losses, then you carry those losses forward into the next calendar year, and you can actually follow this exact same process. And for clients on the line, just know that we do this automatically if you allow us to, which is important for years like 2022 or the COVID dip, where the markets are very volatile, providing a lot of great opportunities to harvest. And to show you this in action, let me give you a real world example of a client of mine. So we had a retired client who was living off of their non-retirement account portfolio, which resulted in about, just say, $20,000 of capital gains each year through the consistent sale of securities. Now, the portfolio had returned an average of about 7.5% a year, and they were in a 15% capital gains federal tax bracket with a 15% marginal tax rate on income and 4 as a state tax assessment. So in recent years, we've harvested a lot of losses. Once in 2020 when COVID hit, resulting in $85,000 of losses for the client, and then $30,000 of losses in 2022. Keep in mind that when we harvest losses, we do reinvest them right away so they don't miss out for the potential for the market to recover. So the losses truly are on paper losses. There's more to this, but for today, let's just focus on the high level strategy. So take a look at this look at these tax savings. In 2020, the $85,000 of losses were used to offset $3,000 of income. In 2021, the losses carried forward, offset $20,000 of capital gains, and then $3,000 of income. In 2022, we offset income once again. And then from 2023 to 2026, we're projected to offset about $20,000 of yearly gains, and once again, $3,000 annually of earned income that will be offset. Ultimately, this strategy saved them, from our calculations, approximately $21,000 through tax deferral. Now, as I mentioned, there's a lot that goes into this strategy. It is more than just selling securities at a loss. So if you're going to do this, just be 100% aware of all the limitations and the specifics to the strategy before executing, and definitely talk with your advisor or your CPA before going and doing it yourself. But to summarize, proper tax loss harvesting is a very forward-looking strategy to lower taxes and ultimately helps your non-retirement portfolio continue to grow. So I challenge everyone on the call to learn more about it and then to begin utilizing it within your planning. So with that, let's move on to the fifth and the final strategy, which is working part-time as a consultant. Now, I bring this up because many retirees, they do like to work in retirement, for fun. And if you decide to do so, I want you to be aware of, in our eyes, the most tax-efficient way to work part-time, which is through consulting or some self-employment. Because being a self-employed individual opens the door for an array of tax-saving opportunities. Essentially, consulting or working for yourself in retirement opens up tax savings opportunities because, as someone who is self-employed, you are able to write off many eligible expenses that you may already be paying for. So let's just review the benefits and negatives before getting into the opportunities for write-offs. And the benefits to working part-time through self-employment are, first and foremost, it does help to maintain a sense of purpose. I do an entire workshop regarding happiness in retirement, and for many, part-time work helps to keep you sharp and enjoying your days. It allows you to potentially leverage that deep expertise you have developed through your working years. It may free up cash flow that you may have needed from investment accounts. And as I mentioned, you may be able to write off some expenses as you are able to, and potentially even save more in retirement plans. And lastly, it does help to maintain both physical and mental activity. The negatives to this, though, are that you do now have additional responsibility, which may not be what you want. You may have less time available to do other retirement-related activities, and there is some accounting and bookkeeping that's some additional work for you. But if you bring in self-employed income, then the door opens wide for a lot of tax write-offs to the right. Many of these you may already be paying for, but they would be in relationship to your business, so you might be able to write them off. For example, health insurance, gas, cell service, interest, your computer, various home office related expenses, all are potential deductions. So let's say you were to bring in $10,000 of income and then write off $4,000 of that, and then you contribute $6,000 to an IRA, you might not have to pay any federal or state tax on that. And obviously, if you're bringing home income, then you don't have to distribute as much from your retirement accounts, which is a great bonus. So I'll leave it at that and say if you have a hobby, or you have the ability to consult, or you have any opportunity to work for yourself and you enjoy it, then you may want to consider it. And it may not only improve your tax situation and your financial situation, but also your happiness as well. And with that, that essentially sums up today's conversation. And I want to end with this. These are just planning strategies. They're just ideas. They may or may not be applicable to everyone on the call, and they may not be right for your specific situation. So it's always best to review with a professional and ensure that you're modeling out your strategies to know that they are good for you and your unique situation. So with that being said, if you're a client on the line and something we reviewed today stands out, come talk to us. Our door is always open and we are always available to talk if you would like to review your planning. And for those that are not clients on the line, if you want to review your planning with us, if you have specific questions regarding your situation, feel free to reach out. While you may not want to work with us long term, we're always happy to be a springboard for ideas. And if you want to talk about what a relationship may look like in the future with us, we're here for any questions you have. So what I'm going to do now is open it up to questions. And for those listening to the recording, I do have to close out before the Q&A. So for those watching the pre-recorded version of this webinar, thanks for joining. Let me close out now, and then I will open it up to questions shortly.